Hey, what is up, YouTube? This is Haidar. I want to talk to you today about the importance of compounding your money. Okay, now there's a lot of people have different perspectives, different opinion about how to truly build wealth in the long term. Some people tell you Shopify, some people tell you you gotta do investing on stocks, some people tell you real estate. Whatever that point is, it doesn't really, the foundation of how to actually truly build wealth is one. And the idea here is that how to make smart investments that are going to compound over the months and years to come, so they can generate either passive income for you or your family, and or create some increased appreciation in the long term, which in return is going to increase your wealth. So there's a couple of things here to keep in mind when you want to build your wealth. There's no such thing called easy way, simple way, fast way. Okay, you can make money in a short, fast way, but it's not going to be consistent. Okay, there are ways to make money in a short term that is going to be fast, but it's not going to be consistent. Okay, now what I mean by that, there are a lot of people out there that have good, successful businesses that generate excessive amount of profits consistently. However, what they had to do before that is they had to spend a lot of time, invest their time, energy, and money to make it steady. Okay, so for the average investor is looking to increase their wealth without putting a lot of grind within 2 to 3 years for establishing a new business, which this is very applicable for people that are extremely busy with their lifetime or their lifespan, with family, friends, and all that stuff, or people that have full-time jobs and they're actually happy with their full-time jobs, or they're satisfied with their full-time jobs and they just want to generate a little bit passive income or appreciation over a long term to retire. So if you're one of these people, this is the video for you. So what you want to understand is you need to make sure that your money is working for you, not work for the money. What I mean by that, a lot of people get into this kind of like rotation of either, there's different layers. Okay, so the fundamental layer here is the mindset of people saying, well, what if I invest my money and I ended up losing it? What if it just gets lost? What if I lose it all? And then there's another mindset of, well, what if, I'm here, I'm young, what's the point of retiring or saving for retirement when I could use it now? And there's another layer where it's the same level one, where people are just saving, or just spending. And the idea here is that you need to address and be realistic with yourself. If you don't take risks in life, you're never going to be comfortable when you're older, or you're never going to retire young, or whatever your goal is, you got to take risk. And it starts really fundamentally. If you're a guy or a girl, you find somebody who's attractive and you want to approach that person, you're taking a risk of rejection. But if you stay there in the corner, you're never going to be with somebody, right? Unless if it's arranged marriage and all that stuff. But you guys get the point, okay? Like babies, when we were kids, most of us, that are walking now, we try to walk multiple times and we fell. But every time we try to walk, we took risks as babies, because we can fall, crack our head, twist our ankle, burst our knees, elbows, right? So we as humans are created to take risks in life. Now, the difference between a worthy risk and a stupid risk is knowledge, research, and experience. That's the combination of what makes a better decision when you take a risk. Having to buy a stock just because your friend is telling you to buy a stock, that's stupid. And I've done that. And don't get offended if you one of these people that are doing that. But that's stupid, because you don't know nothing about this company. You've never done any research, but then you get pissed off when you lose money and you get discouraged and you never invest in stocks anymore. Right? People that want to buy properties, real estate. Oh, tenant can trash your house. Oh, like plumbing can go bad, electric can go bad, roof can go bad, okay, yeah, all of these are true in real estate. But I'll give you an example. It's all about how you know and do your research, and also inspect and research and do all that, how you teach yourself. I'll give you an example. I bought a property before this whole market real estate started going crazy. Last year, around, I would say, I'm sorry if there's a lot of noise right now. It's extremely heavily, it's raining heavily right now, so I do apologize. But I bought a real estate property. It was like last year, and right now, it's so up high in value-wise that if I would sell it, I would make between $30,000 to $40,000 in profit. Not only that, but it's been cash flow. It's been cash flow real good. So, I could have been one of these people where like, hey, it's not gonna work. It's what if the tenant trashed my house? Blah, blah. You gotta scan the tenants. You gotta know how to establish your contract right. And if you don't know it, it's okay. It's okay. We learn someone. But what I want to focus on, you guys, is that the fact of the matter is, you always need to make sure you work your money. You got to make your money work for you. And if you're just sitting, if you're one of those people that are just looking at their money on a daily basis and it's growing and you love it, well, guess what? It depreciates every year. So you're guaranteed to lose money in value over the years. What is depreciation? Depreciation is because of life expenses. Inflation. Okay? Inflation. What is inflation? Prices go up every year. The dollar that $100 today, it was not as powerful as $100 100 years ago. Why? Because of inflation. So money loses value over time. Inflation is between 2 to 3%. Let's say in the bottom line is about 2% a year. Let's say you have $10,000 in the bank. Well, 2% in a year, and in 10 years mark, it's going to be 20%. What is 20% of the 10,000? It's $2,000. What does that mean? That means you, my friend, has lost $2,000 in value from your total money saved. Now, I'm not saying you shouldn't save. That's not what I'm saying. There are people out there, yes, they're just struggling to save 1,000, but there are people out there that are having 100, 200, 300,000 in their bank account. They don't know what they're doing with it. And that's where it's going to cut you off guard. So you got to make sure, and again, this is my personal opinion, so you do your own research because I'm not a financial advisor. You got to save between 3, 6 months, 9 months, 12, whatever your comfortable risk is. You got to have this saving net. And every penny after that goes to investing. All right? And I hope you guys understand this. And I really hope this has been very helpful for you guys. If it is, please make sure you like and subscribe to me. Give me some comments below. Ask me if you have any questions. What investments you have been in, And if you have any questions about what type of investment I'm in, please let me know and I'll be more than happy to get back to you. Take care. Have a nice day.